Ontario is a regulator, an educator, a thought leader, and an advocate. We protect the public. We advance our profession. We guide our CPAs. We are CPA Ontario. And by viewers like you. Thank you.
Buy low, sell high. That simple rule of thumb took stock markets on a wild ride recently, thanks to social media and a merry band of small investors out to stake their claim. Tonight, we'll simplify and explain the complicated and inexplicable of how GameStop trading nearly broke the stock market. Then we'll explore whether it's a harbinger of democratization or chaos that could yet upend other kinds of investing. It's Monday, February 8th, and that's next on the agenda. Short selling, dumb money, retail day traders, and of course, hedge funds. All kinds of terms flying around when stock market news jumps from the business pages onto the front pages, as happened recently after social media-fueled investors took some unassuming stocks on a wild ride. Greg Taylor is the Chief Investment Officer of Purpose Investments, and he joins us now from Caledon, Ontario, to help make sense of how it all works. Greg, are you ready to take us through a little course of Investing 101 here?
I'll do my best to try and help out.
Terrific. Could you please explain, here's a new term to many people, no doubt, how shorting works?
Yeah, so short selling is a concept where it really, when you get to markets and you feel that the positions in different stocks are overvalued and you don't want to buy them, but you feel you can make money if they actually go lower, what you do is you short sell. And what that means is you're actually selling the security, though you don't own any of it. So what you're actually doing is you're borrowing the shares and you're selling them on the exchange. So someone else is buying it from you. And your position on your balance sheet would be that you're short that company. So at some point, you're going to have to buy it back. So you're really making a bet that that share prices of that company is going to go lower.
So just to clarify, you borrow the stock and you pay a fee for the privilege of borrowing it. Is that right?
That's correct. So when anyone goes and buys a stock on the exchange, when you get the share to settle, you'll get, in theory, a stock certificate on the other side to say that you own the shares, and that's yours for as long as you want to keep those shares. Now, if you want to short the stock, you're actually going to be selling it, but you don't have any shares to deliver to the buyer, and the buyer is going to be looking forward to trying to get some shares. But that's going to be a problem. So what you have to do is you have to go to a custodian or a prime broker and borrow that share certificate so that for that transaction to settle, you're going to be able to deliver that share certificate to the counterparty to match, and they can have the share certificate.
And how long do you typically borrow a share for?
Well, it's an infinite contract. So if you're trying to borrow and short a company, you will get a rate, which is going to be an annualized interest rate that you have to pay for the right to borrow the share certificate to settle the share. And there's no term on that. So it could go infinite there as long as you want. Most times short sales are in a few weeks to a month period. So you don't want to do it for too long because it does have a cost, and you don't want to be paying that cost when there's hard enough to make money in the stock market to begin with without having to pay a borrowing fee on top of that.
In which case, how do you make money from shorting?
So when short sales is when you look for an opportunity where you think the price of a stock has gone up more than it should have, in either too fast or just gotten too overheated and a crazy move with a stock market bubble. And you're really making a bet that that company is going to go lower in price due to a fundamental reason or a technicality. And you're really hoping that that security is going to go lower. And when it does go lower, you have to close off the trade by buying it back. Once you bought back the same number of shares that you had shorted previously, it'll net out on your account, and hopefully you're buying back at a lower price than you sold it. So it'll still be the same as buy low, sell high. You're just doing the sale first and then buying later to cover.
Can you appreciate how it might sound odd to quote unquote regular people that you would actually make money when a stock does worse?
Yes, but I think what this is all about is just trying to increase both volume in the market and also increase market efficiency. Everyone wants to believe that the stock market and the economies have the invisible hand that'll try and always get to the right price over time due to supply demand. And if people are shorting, that's more of a check in the system that if something's going up too fast And people will say, well, that price is crazy. And then before, if there was no short selling, you could just sit there and look at it and really do nothing. Because if you had held it and sold it already, or if you didn't own it at all, there's nothing you could really do other than complain about it. But with short selling, there's a mechanism that you can actually can either try and get the price to go lower or be positioned from your portfolio so that you would benefit if it does go lower.
Now, is this something that sort of the typical mom and pop investor can do, or is it really only insiders who know the system that can do this?
Well, you have to have a special account. So you can't just do this in most accounts. You have to get approved by your broker to make sure that you have the sophistication to do this. You also have the ability to line up the borrow that I was talking about before, because technically in most jurisdictions it is illegal to short a company that you don't have a borrow to match off the shares. So this is really something that's normally done through institutions, mainly hedge funds that we can talk about. But so retail investors can do it. You just have to make sure that you've gotten through the correct accounts that are opened up, and your account and broker are allowing you to do this.
Okay, last thing on this, and that is there are a variety of risky investments and instruments that you can partake in on the stock market. If you were going to make a hierarchy of them, where does shorting come on that list?
Well, I would say that from a day-to-day movement on the stock market, I would say shorting is one of the hardest things to do in the day-to-day activity. Generally, when markets do go higher over time, it's easy to say I'm just going to buy a basket of securities or indices, and I'm not going to look at them in 20 years, and I'm going to hope that they're going to be a lot higher. Shorting is much more tricky. You have to figure out where you think there's a mismatch. You have to make sure that you're able to execute on selling it. You're going to be paying a borrowing cost, so it's not something you want to leave on for 20 years and not look at. And it's really quite a difficult thing to do because there's so many things that are going against you that could go wrong. There's a saying, markets can stay irrational longer than you can stay solvent. And that's definitely something that comes up in the shorting argument, because you can say, well, this price of something is crazy, but things do double, things do get taken over, and it's always in the eye of the beholder. And if someone views it's worth a lot more than that, you could be doing all you can and it's going to go against you, and that can cost you a lot of money. So I would say short selling is one of the things that's up there the most. I think derivatives would probably be even trickier than short selling, but from an average buy and sell point of view, shorting is more difficult than buying.
Okay, let's go to our next bit of jargon here. Pair trading, what's that?
So pair trading is a concept where you look at two different companies and you think that the relative value of the two has gotten too extreme. A perfect example would be to look at two of the Canadian banks. Most people think that generally the Canadian banks are all pretty much the same. They're all going to act about the same depending on the economy and different market conditions and interest rates exposure. So say you had decided that the valuation of Royal is worth more than the value is looking extreme compared to what TD is trading at. So that would be almost a market neutral pair trade where you would say, I want to short off Royal Bank because I think it's expensive, and I will buy a share of TD or with the proceeds to match off. So you've got the same dollar value exposure. And you're just going to hope that the valuation difference between Royal and TD will contract, and you're going to make money on that game, and you're not taking on any market risk, which could be depending on what the economy does or what interest rates do.
So based on that definition, it sounds like there is a relationship between shorting and pair trading. Have I got that right?
Oh, absolutely. So if you're going to do a pair trade, you need to have a short on the other side. And there's different ranges whether you want to have a perfectly matched pair trade, so you're going to have actually your dollars match off from the beginning, or if you just want to do it where it's one side or the other. Another example of a common pair trade that people put on is when you want to look at resource companies. So say you're looking at the gold companies and you really like this gold company you're looking at, but you're really not sure what the price of gold is going to do. You can buy that gold company and then you can short off the price of gold by shorting an ETF that holds gold. And you're really just exposed to what the management can do to either find new deposits or grow the company, and you can take off a risk. So within different types of pair trading, shorting is a great way to isolate out different risks of your portfolio, so you can really only take advantage of something that's more meaningful to you.
All right, we've done shorting, we've done pair trading. Let's go to our next one, which is hedge funds. Everybody's heard of hedge funds. I'm not sure everybody knows what exactly they are, so tell us.
Well, the definition of hedge funds has changed a lot over the last few years. Hedge funds, as you would have expected from the name, is a fund that's normally hedged. So it's a fund that really and ideally is going to go and make you money regardless of what the market does. So you're not going to be as worried about, okay, if the market's going to go up 20% or down 20%, I want this fund to deliver X percent. And it's usually in the high single digits, low double digits range is what they target. But the definition of hedge funds over time has changed. It's no longer about a market neutral. It's almost started to blur the line to become a more aggressive type fund. To invest in hedge funds, you have to be an accredited investor, and that rule changes depending on what jurisdiction you're in. But usually it requires for high net worth individuals that are willing to take on a little more risk, get into a more sophisticated product. And hedge funds are a good way to look at that. They're going to be trying to do something different that you can't buy in the market normally, and different than normal index fund. It can have varieties of strategies from short selling. It can be looking at more options overlays. It can also be looking at private securities. So you're buying something that's not traditionally on the stock exchange and have access to different vehicles that normally you can't get. So the definition of hedge funds changes over time, but it's really a more sophisticated type of product that normally you can't get access to.
And if it's targeted to high income individuals, what, ballpark it, what are we looking at there?
Well, normally for a accredited investor, it's someone that has a median income higher than $250,000 a year, or assets under their personal wealth over $1 million. It does change by region. So these are higher net worth individuals that are willing to take on a little more risk and use it for a portion of their investable assets.
Now, you work for a hedge fund that is in the province of Ontario. We hear a lot about hedge funds in the city of New York. What's the biggest difference between the two?
Well, I think the biggest thing is really scale more than anything else. The Canadian hedge fund community is not as nearly as developed as New York. New York would be where the dominant amount of hedge funds are globally. And that's really probably in the magnitude of 90% of all hedge funds in the world would be in New York. So they get really a concentration of people that really spin off from the banks that are dominating on Wall Street. And then they create different niche strategies to try and to get more assets and also to try and generate some alpha versus the stock market. So New York is definitely a more developed market. Toronto's trying to get up there, and I think Toronto over time will start to add more strategies, but the bulk of the assets are always going to be in New York, and it definitely dominates in a global sense.
Is it not the case that many hedge fund people in New York get together from time to time and discuss essentially strategy, how they want to roll out their ideas? That happens, right?
It does, and it's become more of a common practice in the last few years. And they have these called idea dinners, where the different hedge funds will get together and they'll start talking about different ideas. And then they'll always try and see if there's strength in numbers, if they can kind of put on the same strategy at the same time. It's also become quite popular in the last few years. So there's different charity events where the charities will put on different events for investors. Hedge fund managers will get up and start speaking about their best ideas. And people will pay hundreds of dollars for the right to go and listen to these hedge fund investors talk about what their greatest short idea or long idea is, and trying to see if there's any ideas that they can share amongst the group. It becomes a bit of a club where people start to really gang up and try and get onto more different trades. And it really goes back to strength in numbers, because if you've got more people doing the same strategy, you can really start to influence the market more than other times.
Well, this is obviously where I wanted to go next. If Loblaw and Sobeys and Metro all got together and said, we're just going to compare and contrast some ideas we're looking at, they'd be accused of collusion. How is this not collusion?
Well, I don't think it's collusion as much from that type of example, because this is really just people talking about ideas and trying to see if this is an idea that's in all the information's in the public domain. And I feel that this company is more expensive than it should be, and I think the price should go down. If a number of people decide, well, yeah, that makes sense, and more people start shorting it or selling it at the same price, you have more of a chance that the stock is going to actually happen. So it's not really collusion as much, because you're not really doing anything nefarious trying to influence the market. What you're trying to do is just more bounce your ideas off others, get a second opinion, and then hopefully you get strength in numbers if more people agree with you, that the whole process will start to work, and we can get to a price that's probably more fair market.
All right, Greg, next one. We've done shorting, pair trading, hedge funds. Now let's look at the difference between retail and institutional investors. What's the diff?
Well, institutions are really more companies, and these are companies that are set up to invest proceeds for clients. So it can be a mutual fund, it can be an ETF provider, it could be a hedge fund, could be a pension fund, which is really one of the most common assets. And this is really just people that are professional investors that are set up with different degrees of clients, different degrees of accounts. And in theory, it's supposed to be more sophisticated because there's more professional money managers that are looking at these assets and starting to put on risk controls and different compliance and trying to make sure that they're managed more along an institutional sense that's more set up than without rules. Retail investors are really more the do-it-yourselfers that have access to the stock market, have some money of their own from savings, and decide that they would rather do this themselves than hand over their investments to a professional to manage. And there's different degrees of this. Retail investors have become more sophisticated over the last few years, and I think we're starting to see more of an opening with the internet and different tools out there that the retail investors, which had gotten a bad name before, are actually becoming quite sophisticated and exerting more of an influence on the stock market.
Well, tell me a little bit more about how they've changed the game, because of course, they're all over television now with their ads on how anybody can get in, and for a small or even in some cases no fee at all, they can be a player in this game. How does that work?
Well, it's really just opening up more tools to the masses. And I think net, this is a good thing. The Wall Street and Bay Street have had a bad rap over the last number of years as being a closed system. And I think having more retailers and retail investors involved and opening up the tools to everyone is going to be better for the overall functioning of the stock market. Now, you will get periods of bubbles and other such where the things get mania, but it really does open it up and become more democratic as people can get access to more tools. Right now, we're seeing the broker and dealers and different platforms offering up different tools such as short selling, more options overlays. And these are sophisticated tools that can be dangerous if people don't use them correctly, but they also are able to bring more institutional style practices of investing to the retail audience. And I think net, this is a good thing, but people do need to realize what they're doing and the risks incorporated in that.
And if they don't charge you a fee, how do they make money?
Well, this gets into a more complicated aspect where the dealers every now and then will have set up arrangements where they can sell their deal flow and some of the exchange volume to other exchanges. And this is really where some exchanges are set up that they'll look at what people are doing on the site. They'll try and do some analytics behind that. And then they'll sell the order execution on top of the information to another counterparty who will pay a fee for that and try and collect a bit of a spread from the bid ask in the market. It only really works in high volume exercises, and that's where you can get it's all about scale in this game, as it is in almost every business. So if you've got some scale, you've got some deal flow, and you've got an edge, people will try and sell that and try and exert a little bit of a fraction of some money between the bid ask spread. So investors are getting a bit of a free ride by opening up their information, but they do have to realize that their information is potentially being sold to counterparties, which could try and clip a little bit of a percentage between the bid ask and what transactions are going on at.
Okay, now, Greg, that we have all of this language and the definitions underfoot and we understand the situation a lot better now, in our remaining moments, you're going to tell us what the heck happened with GameStop this past week.
Yeah, so the GameStop phenomenon is going to be quite interesting, and it's definitely going to be leaving a mark and something that the regulators are going to have to look at over time. But really what it was an example that the retail investors started to turn the tables on the hedge funds. And it's going to be fascinating just to see how this plays out. Because really what happened is, and this goes back to the idea dinners or people talking about their shorts from a hedge fund point of view, in the last few years, we've had a number of hedge funds that have really targeted different parts of the market, mainly the retailers. And they're looking at the traditional mall-based retailers and thinking they're structurally broken. These are business models that aren't going to work. So a lot of these hedge funds had shorted these names, GameStop being one of the most apparent ones, thinking that there's a lot of trends going against it. And it's a company that's really in structural decline that's maybe not able to be fixed. And when you get these short positions and different theses, a lot of these hedge funds like to talk their books. So they'll be talking to people in the media, they'll be talking to different counterparties and saying, the best trade out there is to short GameStop. So it became quite well known that a lot of these hedge funds had shorted GameStop. And you can see it in different reports. Different companies publish the companies that are most shorted on different databases. And you can see that GameStop was one of the companies that was the most shorted. What happened to turn the tables on this was a group of investors on different chat rooms, the Reddit boards, decided, well, we can create something called a short squeeze. And that's a different term we haven't discussed on, but a short squeeze is basically when you know that a lot of companies are short. If the stock starts to move higher, kind of going against what you want it to do, it throws off a lot of your risk controls. And the compliance officers at these institutions and hedge funds will start to tap the portfolio managers on the shoulders and say, this is something going against you. Be concerned. Make sure you're aware of this. And if it gets too out of whack, you're going to have to take that trade off because we don't want to bring down the firm. What happened with GameStop of this is that as people started to realize how short it was and how people started to go the other way to balance off their risk, it started to become a pain trade that as it went higher, it became worse for the hedge funds and better for the retail investors. Where it got more complicated and again, something different than a normal experience is the use of options and derivatives. As these retail investors were buying fairly out-of-the-money calls, which is a very sophisticated strategy to try and move the stock of GameStop higher to these levels. And then it basically became the short squeeze that cascaded out of control as the compliance officers were telling all these hedge funds within days, you have to take these trades off, you have to buy it to match off. And to buy it, they had to price the stock up a lot. And that's where we got GameStop moving from $10 to $400 within a matter of days. And it really was more of a technicality run by compliance officers more than anything else.
In which case, when you see the kind of volatility we've seen in this stock over the past couple of weeks, do you think the average person looks at the stock market and says, this is a complete racket? I mean, this is a joke. Look what happened.
It is, and it's probably something, again, that the regulators are going to have to look at, because at the shares of GameStop, there was more than 100% of the stock available outside in a short interest right now. And that's something that really needs to get looked at, because it caused a bit of the short squeeze, and it got more extreme than others with the use of these options. So I think the thing that people are going to have to look at is, should everyone have access to trading options? And also, do we have too much risk in the market if these short squeezes get out of control? At the end of the day, this is something that I don't think is going to happen a lot. This was very like a perfect storm as people were crowded in. I think it's going to be harder to replicate over time. But the regulators are going to have to watch this and make sure that some of these more sophisticated tools, which have now become in the hands of the retailers, retail investors, if they are going to be able to be used for good, or if it's going to start to hurt people over time.
That's Greg Taylor, the Chief Investment Officer of Purpose Investments. And Greg, not only do I have to thank you for coming on to TVO tonight, I got to tell you, that's the best definition of all these complicated phrases and expressions I've ever heard. So thanks for walking us through all that. Appreciate it very much.
Perfect. Thank you. Hope it helped.
Social media lets people with similar interests find each other, band together, and even rally others to a cause if they're so inclined. Mostly that's been around social, cultural, and political issues for good and for ill. But a few weeks back, that crowdsourcing power was directed at the stock market and took serious money and stock values to outer space and back again. It roiled the markets. But could it also signal a new kind of disruption with a much wider significance? Let's ask. In Oakville, Ontario, April Fong. She is Deputy Managing Editor of the subscription news service, The Logic. At Harbourfront in the provincial capital, Navneeta Lang, tech columnist at the Toronto Star. And in the Witchwood neighborhood in Midtown, Brian Milner, freelance business writer and economics writer. And we're glad to have all three of you on the program tonight. I think maybe the most sensible thing to do as we start our conversation here is just to follow up on anything you may have heard Greg just say that you think is worth either pursuing or just making an additional comment on. So let's start there. Brian, get us off to the races, if you would.
Well, I would like to expand a bit on the issue of institutional investors. It sounds as if these are all like giant investment funds and big companies, but he did mention that pension funds are big players in this game, and in fact, they are among the biggest investors in hedge funds, which means that when a hedge fund loses a lot of money, it's not just some billionaires sitting in New York who get hurt. It's all the people who are involved in those pension plans, and that's thousands and thousands of little people. So I think that needs to be expanded on a bit, because the fact that that's our money that's going into these funds means we all get affected.
A good reason for all of us to care and not just the billionaire class, right?
Exactly.
Okay. April, why don't you follow up? What was of interest to you that you wanted to follow up on?
I thought Greg did a really great job, first of all, of explaining some really difficult parts of financial markets in a plain language type of way. I thought that his comments on idea dinners was really interesting, and it kind of makes me think about how Wall Street Bets perhaps is being used as a idea dinners of itself, where people are coming together and sharing their ideas about the stock market.
We're going to follow up on that in a bit, because Wall Street Bets is a neat new thing that deserves some further conversation. Navneet, your turn. What did you want to follow up on?
Yeah, I mean, I think it's worth pointing out that, someone who works at a hedge fund is obviously going to have an investment in defending hedge funds. But I think the notion that Greg referred to, the invisible hand and the market pricing things efficiently, is something that we should poke at a bit. I think that the outsized power of the wealthy and institutional investors and hedge funds, I think suggests that the market isn't quite as democratic as perhaps he was making it out to be.
In which case, Brian, follow up with this. You know, the media are always looking for the next David and Goliath story. Do you think the GameStop story was a David and Goliath story?
No, I don't, because David actually won. And in this case, most of these small investors are going to be losers. In fact, most of them already are. A few people made money, few small investors. Most of them got outflanked by the big players pretty early in that game. And among the reasons for the huge rise in GameStop were professional investors jumping in and saying, wait a minute, this is going to keep going up and I'm going to make some money out of this. But unlike the small investors, they get in and out very quickly.
April, in your view, did Goliath win in this David and Goliath story?
I agree with a lot of the comments that Brian just made. And I think that the mainstream media really played on this idea of a David versus Goliath story, but it's a lot more nuanced than that. We have to remember that billionaire investors made a lot of money on this market volatility. And a really interesting thing that I'd like to bring up is there was a JP Morgan report that found that the top retail trades, GameStop didn't even make it into the top 10. So it really suggests that there was a lot of bigger players involved, institutional investors who were involved. So as much as we talk about this being a David Goliath versus Goliath story, there's also a lot of Goliath versus Goliath here.
Navneet, where are you on that?
Yeah, I mean, I think it's useful to kind of distinguish between the way that this sort of played out symbolically and the way that it played out practically. I think symbolically, I think this did elucidate some of the ways in which hedge funds have outsized power in the market. Practically speaking, though, I think it's worth pointing to the fact that a lot of people in the Wall Street Bets subreddit, were aware of quite sophisticated financial tools, or they had access to Bloomberg terminals, which are quite specialized equipment. And so I think the notion that they were merely just a little guy, I think is a little bit suspect.
All right, April, this is twice now we've heard about Wall Street Bets, so let's go there now. Start by telling us what, in fact, it is.
Well, it's a thread on Reddit started by an individual who goes on YouTube as the name Roaring Kitty. And actually, an interesting fact about him, he's also not necessarily, your the little guy, as Navneet described. He's a chartered financial accountant himself, analyst himself. So he has, some knowledge of the markets more so than some others.
So the allegation here, Brian, is that, on this subreddit, on Wall Street Bets, there are now, I guess, a lot of allegations that there was some collusion going on, which might help explain all the craziness on the markets not too long ago. What do you think about the reliability of those allegations?
Well, I think they do have to be investigated. And Keith Gill, the guy who goes by the name Roaring Kitty, I keep wanting to say hello, Kitty. he is not only a registered financial analyst, but he was working until very recently for a giant insurance company, Massachusetts Life, in the equity department, where he was involved in marketing equity stuff. So there's some question about whether they even knew that he had this very lucrative sideline running this platform. And it is reputed that he made millions of dollars out of these transactions.
Well, Navneet, purposefully manipulating the market in order to enrich yourself is, of course, illegal. But when it's a disorganized group of anonymous people on some internet chat site, that's not the same thing, is it?
I mean, it's really kind of difficult to sort of make that determination. I think that what is much more likely that happened is that it's not that the million or now even more than that subscribers to Wall Street Bets were involved in collusion, but that the small number of people that were driving the frenzy on Wall Street Bets may have been purposefully pushing people to invest in a particular way that pushed a stock in one direction or another. And so I think that going forward, I don't think that you can police the way that people discuss things with each other or discuss the stock market with one another. But there may be a sort of a need to put in place mechanisms that will prevent people from sort of misleading large groups of people using social media.
April, in your view, how close to collusion did the behavior on Wall Street Bets come?
Well, I think, just like Navneet and Brian have pointed out, this is something that we need to look at more closely and understand that, people are behind screens discussing companies and may not have the expertise to be giving out advice to other people.
Let me read something here that Jill Carlson published the other day. She's a columnist for something called CoinDesk, which does cryptocurrency and blockchain news. And she wrote just a few days ago the following: think of the portrayal of trading desks in every bit of media you have ever consumed. The people pounding the desks and putting their fists through screens, the bosses swinging baseball bats around, the rolled up sleeves and dilated pupils, the obscenities. When Yale-educated men in button-downs engage in these behaviors, they become the masters of the universe. Yet when anonymous online avatars and energetic YouTube personalities do so, they are cast as immature, basement-dwelling kids. Okay, Brian, are they onto something there?
Well, and certainly in some ways. I mean, the mythology around Wall Street certainly plays a role in all this. But I think it's very true to say that they're not necessarily kids, but we know they're young males. We know they're bored. They're stuck at home because of COVID. They've got money. They may well be tired of playing online poker. And some of the investing things that they're doing don't make any sense from an investing standpoint, but they make a lot of sense from a gambling standpoint. They're getting gamblers' highs. When GameStop started rising, the way they were describing their feelings is exactly what you'd see from a compulsive gambler.
Navneet, how about this notion that if there were the masters of the universe exemplifying this behavior, we'd think it was all so cool, but these kids do it and suddenly it's awful? Fair point?
Yeah, I mean, I think, one way that you could look at this is to flip that sort of contrast on its head. And it's not that the Yale-educated men on Wall Street are the masters of the universe and the kids on Reddit are the basement-dwelling kids, but the Wall Streat itself has been this kind of sort of volatile, immature, male-dominated space, and that investing is itself a kind of like a masculinist sort of gambling arena in which people risk their own money, but also risk other people's money. And so I think that it's a fun contrast to make, particularly if you're trying, if you're a traditionalist and you're trying to dismiss what happens on social media. But I think that it might actually, there might be a lot more similarity between who's on Reddit and who's on Wall Street than people on Wall Street would like to admit.
Well, April, part of the suspicion here is that these younger people, with their freshly minted stimulus and pandemic checks in their pockets, had the cash to play around and did so. Is that accurate as far as you know?
I mean, I think that's a really, I just wonder if it's so black and white, right? It's a really convenient way to portray our pandemic-fueled stories. So it's a good question to ask. I don't know how true it is.
Okay, let's, Navneet, go on, because I want to ask you about something that you had in the Star just recently. You wrote in your story how the aggregating power of social media allows a very small number of people to distort and disrupt. Amplify on that for us, if you would.
Yeah, I think the Reddit is a good example of the ambivalence of social media and the internet. Like, so on the one hand, the aggregating power of the internet, what it allows people to do is gather around a topic, find like-minded people, and form a kind of a collective or a mass of people that together has far more power than people would have individually or would have had prior to social media. I think that the ambivalence to that comes in where, that can be quite positive in the sense of, that we've seen movements like Me Too, like Black Lives Matter kind of coalesce online and gain more momentum and gain more power through that aggregating power. But we've also seen, targeted harassment campaigns. We have seen election interference. We have seen misinformation and the rise of conspiracy theories that also arise through that aggregating power. And so I think that's where my kind of skepticism comes from, is that if we sort of uncritically celebrate that aggregating power, we may also be welcoming movements or trends in society that we would actually like to sort of tamp down on.
Yeah, Brian, one of the things you also hear is, on these chat sites, you will hear people say, all I need is to have Elon Musk say one nice thing about this stock and it's going to go through the roof. And in fact, that's kind of what happened with GameStop, right? Elon Musk had something positive to say about GameStop, and it went right up into outer space. Do celebrities, as a general rule, are they able to play this kind of outsized role in the movement of stocks?
Well, there's no question that influencers are having a role in driving some of these things. There is an interesting sidelight to the Elon Musk thing. As soon as Elon Musk issued that tweet, basically telling people to jump aboard, one of the big funds that had been long in GameStop and had bought the shares at only $10 a share sold almost immediately as soon as Elon Musk opened his mouth. And they're now known as the company that uses Elon Musk as a sell point. If Musk tells you to buy it, get the heck out. And they made about $600 million profit. But Elon Musk is not the only influencer who was involved in these things. There were 3 or 4 major players who said, yes, let's get on this thing. Elon Musk hates short sellers. He despises them. And as soon as he saw that this was creating a terrific short squeeze and screwing some of those big hedge funds, he said, great, let's do it, because he'd like to wipe out short selling completely if he could.
April, what do you think of this phenomenon of celebrities either touting or talking down stocks and having outsized influence given their knowledge of the markets?
Well, I think that, social media's effect on the stock market, it's definitely come to light in a really big way in recent weeks. But as a business journalist, it's been interesting because it's not just these celebrity investors, these few celebrity investors in the last couple of weeks. I think we've been watching and waiting for Trump to tweet and looking at how he affects the stock market or affected the stock market before. And so that isn't really new, but it's definitely new in the sense that these were really big moves. The other thing I would say is I would just go back to the old investing advice of, trying to differentiate between market noise and, signal the financial health of companies, right? You, as an investor, that's one of your responsibilities is to differentiate between what information you trade on and what is just noise.
Yeah, we wonder though, Navneet, why don't you pick up the story here? You wonder how much of that is going to be happening going forward, given that we've got these so-called financial gurus, for example, on Twitter, who talk about the stocks that they're going to be buying and where they think it's going to be going. And obviously that can have a greater or lesser influence on what others do as well. Others hold with the idea that the price seems to go where they predict, and then, we're off to the races. Does this either help or hurt, do you think, open up the stock market for the average investor?
I think it could be both, but I think the looming problem is that when markets move based on what happens on social media, they move in relation to sentiment rather than market fundamentals. So I think that with the GameStop example, it was moving because of a sort of, what was going on Wall Street bets, and then expanded through social media. And then it was just this sense of, people had to sort of get in on what was happening, this sort of sudden frenzy in the market. And it's not that people were looking at GameStop as a business, right? I think it's worth pointing out that the reason that GameStop's business sort of collapsed so much is because it's a retailer of physical video games, right? So it very likely will end up going the way of Blockbuster Video, regardless of what happens with the current stock price, because it's a market that is slowly dying. And I think that tendency to sort of focus on what is sort of currently hot, or what people are talking about, I think is one of the ways that social media can sort of distort, what you might hope, at least in theory, is sort of the rational functioning of the market. Whether or not the market is actually rational, I think, is of course a different question.
I know there's some 20-somethings who are thinking to themselves right now, what's Blockbuster? Never heard of that. Back in the day, it's how we watch videos, everybody. You know what, Sheldon, can I get a 3-shot here? I'm just curious. You three know the markets better than most. And you three watch this story unfold with a level of sophistication that, again, most would not have. Can I see a show of hands? How many of you got in on it? Who bought GameStop here? I'm seeing two people shaking heads. Brian, did you get in on it?
No. Not a chance.
3 people all shaking their heads. They were not because the temptation to ride this roller coaster was there. Brian, why didn't you get in on it?
Well, the same reason I didn't buy Bitcoin 3 years ago when everybody told me I should, and the same reason I didn't buy marijuana stocks 5 years ago. These are frenzies, and you'd have to be crazy to jump into things that make no economic sense. If you had a vision that GameStop was going to turn itself around, that the new CEO really had a great game plan, then you might be interested in buying the shares when they were beaten to a pulp, as some funds did. But as it was shooting through the roof for no logical or economic reason, you wouldn't want to touch that stuff, because that is frenzied buying, and all of these things disappear very quickly.
People make money, though, April, during frenzied buying. How come you resisted the temptation to partake?
I think that one of the best pieces of advice out there for investing is to buy into or invest in what you understand and know. And just because something was making the news and making headlines and shocking everybody, I think that's actually a reason for me to try to ignore it.
You are from the Warren Buffett school on that one. Navneet, how about you? You didn't get in either, eh?
Well, no, I mean, I'm a freelance writer, so I'm not sitting on piles of money waiting to throw into the market. So these are the effects of working in Canadian media. But no, I mean, I didn't get in because I think like a lot of people, I have sort of post 2008 anxiety about, sort of complex financial tools and strange market moves. And I think I was immediately skeptical, I mean, certainly there's that FOMO, the fear of missing out, but I wasn't willing to risk what tiny amount of money I do have.
Did you bet the Super Bowl yesterday instead?
No, actually, I don't watch American football, so.
How did he get on this panel if he doesn't follow the Super Bowl? I don't get it. Anyway, all right, let's move along. Brian, did you make any money yesterday, incidentally?
No, I don't bet on football either.
I'm confused. Am I the only guy who bet on Tom Brady yesterday and won just a little money? It's the one bet I make during the year. because I
How
understand
much?
football. I won $50 yesterday, but you know, I understand football. I don't really understand the stock market as well as I understand football. Let's move on, kids. Fighting shorts. A lot of this story had to do with the fact that there were people shorting stocks and, you know, as we've heard earlier in the program, betting that these stocks were going to go down. And I do want to play this Elon Musk tweet because it did go viral at the height of the whole GameStop thing. You want to bring that up, Sheldon? Here we go. Here's Elon Musk, who says, you can't sell houses you don't own, you can't sell cars you don't own, but you can sell stock you don't own. This is, and there's a technical term, I think, for some kind of agricultural product. This is BS. Shorting is a scam, legal only for vestigial reasons. Okay, Brian, is he onto something there?
No, the fact is that short selling is a perfectly legitimate tool that, in fact, it has been proven very valuable over many years. And as a financial journalist, you will never see me criticize short sellers because they have uncovered some of the biggest scams in the market. They've uncovered fraud in businesses. They do their homework if they're good at it. And all of us have gotten great stories out of people who do this kind of research. And I'll tell you a story about a Canadian stock called Sino-Forest, which was supposedly one of the biggest owners of forest land in China. A short seller named Andrew Left went to China and decided to find out how much trees this company actually had and found out that most of the business was fake. That company completely collapsed. The market launched a big investigation. Regulators probed the illegal stuff involved. And he was right, but nobody else was pointing this out at the time.
April, Elon Musk seems to think that shorting is immoral. What do you think?
Well, I hate to go up against Elon Musk, but I think that short selling, like echoing some of the comments that Brian made, it serves a really important function in financial markets. You know, it can help to uncover overvalued stocks, which, you know, I know it doesn't seem like it right now in today's market, but that's a really important function for investors. And also uncovering accounting inconsistencies, shady business practices like Sino-Forest. Those are really important things that you need in the markets.
Navneet, any ethical qualms by you on the issue of shorting?
I think that might be slightly above my pay grade, but I think it's worth pointing out that Elon Musk may have his own reasons for not liking short selling. You know, he is currently the head of a company that is most obviously known for its electric cars, but it doesn't make money on the electric cars that it sells, right? It's still losing money on Teslas, and really only makes money through carbon credits. And so I think that there's good reason for people to short Tesla stock because it is, you know, up to $850 and there may not be any particular reason for it to be that high.
Well, other than confidence that people think that he's going to, you know, go through the sky someday.
I mean, it is true. I mean, that, you know, for a very long time, Amazon did not make any profit, and then now it's, of course, you know, one of the largest companies in the world. So, you know, there is a case to be made for it. But I think that there's also good reason to be skeptical of Tesla and Elon Musk specifically.
Go ahead, Brian.
We should add that there are sophisticated short sellers who have attacked Tesla for years, and they have been getting hurt because Tesla keeps going up and up. They may end up being proved right, but they'll have to have pretty strong stomachs to keep going.
Brian, though, let me follow up with this. You know, GameStop at one point was shorting 140%. 140%. In other words, there were way more stocks on loan than there were stocks in total. Do you think the hedge funds are going to think twice going forward about how much shorting they want to do as a result of this experience?
Well, I think there's no question that they're going to have a close look at what they hold in terms of short positions and whether they're out of balance. I do agree that this company deserved to be shorted because it really has a bad business strategy. But there's a limit to how much money you should pour into a stock that's already been beaten to death in the first place. I think the bigger targets are the Teslas, where there's lots of room for decline, and the key is how long can you wait it out?
How long should we expect to wait it out?
Sometimes it can take years. There is a famous hedge fund manager named David Einhorn who spent 10 years attacking a company called Allied Financial, going back to the 90s. He knew they were involved in all kinds of fraudulent activity. They attacked him mercilessly. They hired private investigators. They tapped his phones. They filed charges with the SEC. And the SEC would not investigate most of the charges that he claimed they were involved in. He ended up spending 10 years trying to short them and eventually gave up. That company collapsed in the 2008 financial debacle, but he didn't win. You have to have really deep pockets to do that kind of fighting.
Okay, let's finish up on this in our remaining moments here, and that is, I guess a lot of average investors, the people, Brian, that you were talking about earlier, you know, they've got their retirement savings in pension funds and so on, in hedge funds as well, and they may be watching the events of the last 2 or 3 weeks and really scratching their heads about what kind of game they've signed on to. Now, there is an old expression that, you know, when you go to a casino, it's not to say that you can't get lucky and win at some point, but generally speaking, the house always wins. And I wonder if that's essentially the same thing in this case, meaning that the hedge funds at the end of the day always win. The game is, at the risk of using a term that got considerable currency in the United States over the past few years, the game is rigged. Navneet, you want to start us off on this?
Yeah, I mean, I think that one of the things that I think is quite positive that has come out of this, and this may be my own, you know, particular perspective, but I think that it has elucidated the ways in which the stock market is perhaps not as fair and as open to all as some purport it to be. And I think that, you know, if you look at statistics, there are only about sort of between 50 and 60% of people who are actually invested in the market, and overwhelmingly the people who are controlling, you know, the way in which the market moves are people who have significantly higher net worth and significantly higher initial investments. And so if you know, for all of my skepticism about the way in which this occurred, if what comes out of this is that the stock market is perhaps not this sort of rational ideal that we hold it out to be, that would be great. And, you know, and I also think it's worth pointing out that, you know, for the last year or so, we've had, you know, we've been living through this pandemic, and the stock market is higher than it's ever been, you know, and I think that suggests that there's some kind of disconnect between what is happening in the market and what is happening, you know, on the ground.
April, you want to continue the story on this and how much you think the game either is or is not rigged?
I think it's a really interesting question. And, you know, this GameStop situation has brought about a number of questions that we need to look at. And, you know, it's hard. What we see now is that retail investors coming together and showing their power as a mass, it is really, really interesting. They have certainly gotten the attention of Wall Street and Bay Street. And I would argue that, you know, before big funds make a position from now on, they may check some of these discussion forums first.
Brian, how about you on this?
Well, I think it's worth pointing out that about 10% of the wealthiest people control about 85% of stocks that are traded regularly. So it is a game for the rich. But ordinary people have been able to get into it relatively cheaply through indexed funds. And as most of us know, since the sharp fall off last March because of COVID, the market has been roaring along ever since. And most people have done pretty well. The average investor is still fairly risk averse. They're pretty happy getting their 6 or 7 or 8% returns. What we're seeing in the latest surge and all this sort of froth in the market are really the speculators. They're not happy with their 6 or 8%. They want 20 or 30%. That's greed. Greed is normal in the market when markets are going up, just as fear is normal when they're going down. And we'll see the greed replaced by fear soon enough when the current market bubble goes. This is pretty normal.
Navneet, last 30 seconds in our conversation to you. Do you think there is a role for increased regulation here?
Yes, I mean, I do think so. I think particularly not in the sense that you want to kind of tamp down on what retail investors do, but the ways in which retail investors may be misled or have their actions funneled by people who have their own interests. So yes, I do think that regulators will need to increasingly look at social media.
Really good of all three of you to join us on TVO tonight. Can I thank Brian Milner, the freelance business and economics writer, Navneet Alayang, whose tech columns you can read in the Toronto Star, and April Fong, who's the deputy managing editor of The Logic. Thanks so much to the three of you.
Thank you for having me.
Thanks so much, Steve.
And that is the agenda for Monday, February 8th, 2021. A new report out of McGill University flags the very shocking fact that child marriage is legal in this country and still happening. Tomorrow, we'll get to that story. Also, we'll find out about efforts in the construction industry to combat discrimination and build a more diverse workforce. I'm Steve Paikin. Thanks for watching TVO, for joining us online at tvo.org, and we'll see you again tomorrow.
The Agenda with Steve Paikin is brought to you by the Chartered Professional Accountants of Ontario. CPA Ontario is a regulator, an educator, a thought leader, and an advocate. We protect the public. We advance our profession. We guide our CPAs. We are CPA Ontario. And by viewers like you. Thank you.
The Agenda is always on. To catch up on conversations from this week or any week, visit our website, tvo.org/theagenda, or our YouTube page at youtube.com/theagenda. It's all there for whenever you want to watch.